Hey, hi everyone. Welcome to another video in our positional option selling strategies series and the adjustments for positional option selling strategies. So today, what we're going to discuss is a strategy called call butterfly positional trade. It's for Indian index markets, and what adjustments we need to do for call butterfly positional trade in Indian index markets. We'll go through some scenarios and examples from Nifty, Sensex, and Bank Nifty, and what adjustment should be done in different scenarios. Okay. So, what is a call butterfly? It is a defined risk option strategy commonly used in Nifty, Bank Nifty, and Sensex positional trading. It's cheaper to enter, has limited loss, and profits are big if the underlying stays within the close to the middle strike at expiring. Okay, but since markets rarely expire exactly in the middle strike, we need to do adjustments based on different scenarios. Okay, so basic call butterfly setup is this is the call butterfly setup. So if Nifty spot is 20,000, then you sell two ATM calls. So you're basically selling two 20,000 Cs. Okay, and then you are buying one ITM call at 19,800 C you are buying, and one OTM call you are buying at 20,200 C. So this is a call butterfly setup. You're selling two ATM calls, buying one ITM call and one OTM call. Okay, so cost is small here, net debit, and max profit is there if Nifty expires exactly at 20,000. Loss is capped to the premium paid. So that's the beauty of this strategy. Okay. So what are the different adjustments that we need to do? So different scenarios are there. Okay, so let's go through all the scenarios. If market rallies strongly, okay, so we assumed that it will stay within a range, and if it expires at a certain strike of 20,000, we'll make a good profit. Okay, and that was our view, and that's why we deployed this strategy. But suddenly the market rallied strongly, and it went above the upper strike, so it jumped from 20,000 to 20,400 in this case. So your butterfly max range was from 19,800 to 20,200, but Nifty moved to 20,400. So that's the scenario. Market rallies strongly. So what adjustments we can do? Two things we can do. One is we convert this call butterfly into broken wing butterfly, that we could do, or we could convert it into call ratio spread. Okay, so how do we do convert it into broken wing butterfly? So the lower strike we have taken, right, 19,800 C, you move that to 20,000 C, C. Okay, so you change that 19,800 CE buy to 20,000 CE buy. Okay, so this creates wider upside profitability and reduces cost. That's how you convert this call butterfly into a broken wing butterfly. If market rallies strongly, okay, and or you do convert it into call ratio spread. You square off the upper buy, so 20,200 you square off. Okay, C, then you will be left with 19,800 C and two a buy position of 19,800 C and sell position of 220,000 Cs. So that would be a ratio spread, and any upward movement the market makes, you will make money. Okay, so you're becoming bullish basically uh, from range bound view. Okay, so that's the example. Again, if bank nifty jumps 600 or 800 points beyond the upper wing, then breaking the butterfly zones, this will you basically change it to a broken wing butterfly or call ratio spread to capture the momentum. A second scenario is market falls sharply, so you have taken a call butterfly, but market has gone against your view. Okay, and it has went against, it has fell sharply, okay, under below your lower strike. So Nifty drops to 19,600 and your lower strike was 19,800. Okay, so what adjustments we could do? We could shift this enter butterfly lower. So you exit this existing butterfly and re-enter a new butterfly at 19,800 to calls you sell, and 19,600 you buy, and 20,300 CE you buy. So that you could do, shift the enter butterfly lower if your view is still, that's going to range with stay within this range. Okay, or you could convert it into a bear call spread. So you exit that 19,800 CE call, and keep 20,000 CA by 20,200 CE. Okay, so that's what you could do, and you convert it into a bear call spread. Okay, so then your view will become bearish, and you will benefit if the market falls or if it's bearish. So those are the two options you do. You shift the butterfly lower, or you convert it into a bear call spread if the market moves sharply against you. If market moves rallies, then you convert into a broken wing butterfly or a call ratio spread. Okay. The market stays sideways, but time decay hurts. If it stays within the range of 19,950 and 20,050 for weeks, butterfly will gain money. Okay, but before expiry, it will stagnate. Okay, so you can just take the profit and leave, or you could add another butterfly, a double butterfly. You could add. Example, you have one butterfly of 19800 CE buy and 20,000 CE sell and 2200 CE buy. Then you add another one, okay, 2200 to CE sell and 20,000 CE buy and 20,400 CE buy. So that's double butterfly. We could add and expand the profit zone. Okay, or you could also do convert into an iron butterfly, add puts, we can do. Okay, so add put side butterfly for extra theta. Okay, so we can add another butterfly called put side butterfly. So what you do is you will add 20,000 PE to s- sell positions, and then you'll buy a 19800 PE and a 20,200 PE. So you'll add an put side butterfly also, which basically converts into an iron butterfly. Okay, so that's what you do when market stays sideways and time decay hurts. You either convert it to a double butterfly or you convert it into an iron butterfly. Okay, so volatility spike if India VIX jumps, when VIX rises like RBI policy, US Fed event, butterfly premiums expand. So you book partial profit here before expiry. Okay, example is Bank Nifty is highly volatile, closing 50% position early when VIX rises, protects gains. Okay, expiry day adjustments, intraday are positional. On expiry days, there will be wild swings and near the strike. So you could basically do a scalping adjustment, convert this butterfly to a short straddle or a strangle on intraday. Okay, so that's what you do. Or you could delta hedge with futures. If Nifty is at 20,150 and your butterfly is at 20,000, short small Nifty future to neutralize the delta. Okay. So those are the different adjustments, guys, and the basic scenarios are, overall, if market rallies, then you convert it into a broken wing butterfly or a ratio spread. Okay, and if market falls, then you roll down the butterfly or you convert it into a bear call spread. If market is sideways, you do a double butterfly or you convert it into an iron butterfly. Volatility spike is there, book partial profit. Expiry days, you delta hedge with futures or convert it into intraday straddle or strangle. Okay. So that's the call butterfly strategy, positional trade, and the adjustments that could be done for it. Okay, so that marks the end of the video. Thanks everyone for joining the call. Have a nice day.